For years, investors enjoyed a relatively calm and predictable market. Set-and-forget investing became popular. This approach favored passive index funds and a long-term outlook. It worked well. However, recent events have shaken investor confidence. The markets have become volatile. This has led some to question the wisdom of passive investing. Is it time for a new approach? The set-and-forget strategy relies on a key assumption. It assumes that markets always recover. While this is generally true over the long term, the ride can be bumpy. Significant downturns can test even the most patient investor. This is especially true if they need to access their investments during a downturn. The current market environment is different. There are new challenges for investors. These challenges include geopolitical instability and rising inflation. These factors add to market uncertainty. They make predicting market direction difficult. In this environment, a more active approach may be necessary. Investors may need to adjust their strategies. They need to navigate the current market conditions. This is where a more active approach to investing comes in. Volatility has returned to the market. This has caught many investors off guard. After years of relative calm, the sudden shifts are unsettling. It's important to understand why this is happening. Several factors contribute to the current market volatility. Geopolitical events play a significant role. Trade tensions and political uncertainties can quickly impact market sentiment. These events can lead to rapid shifts in investor behavior. Economic factors also contribute to volatility. Inflation is a major concern. Rising inflation erodes purchasing power. It can lead to higher interest rates. This impacts company valuations and investor sentiment. The interplay of these factors creates a complex market environment. It's challenging for investors to predict market direction with certainty. This uncertainty is reflected in market volatility. The CBOE Volatility Index, often referred to as the market's fear gauge, has spiked, indicating heightened investor anxiety. In times of market turmoil, investors often seek safety. They turn to asset classes that are considered less risky. These safe havens offer protection from market downturns. They may not offer high returns, but they provide stability and capital preservation. Money market funds are one such safe haven. These funds invest in short-term debt securities. They are highly liquid and considered very safe. Investors favor them for their stability. They are particularly attractive during times of market stress. Short-term bonds are another option for risk-averse investors. These bonds have maturities of 1 to 5 years. They offer higher yields than money market funds, but they carry slightly more risk. Investors favor them to manage interest rate risk. Gold has traditionally been a safe haven asset. It is a physical commodity with intrinsic value. Investors turn to gold during times of economic uncertainty. They see it as a hedge against inflation. Gold can hold its value when other assets decline. Section 4. Active management's time to shine. Active management involves making strategic investment decisions. This approach aims to outperform the market. It requires skilled portfolio managers. They analyze market trends, assess company fundamentals, and make informed investment choices. Active management can be particularly valuable in volatile markets. In a set-and-forget approach, investors typically hold a diversified portfolio of index funds. They ride the market's ups and downs. This passive approach works well in bull markets, but it may not be optimal during periods of heightened volatility. Active managers can adjust their portfolios more dynamically. They can reduce exposure to overvalued sectors. They can increase holdings in companies with strong fundamentals. Active management seeks to capitalize on market inefficiencies. Active management is not without its critics. It often comes with higher fees than passive management. Not all active managers outperform the market. However, in volatile and uncertain markets, the flexibility and expertise of active management can be beneficial. Section 5. Options for a tumultuous market. Options contracts provide investors with flexibility. They can tailor their investment strategies. Options give investors the right, but not the obligation, to buy or sell an asset at a specific price, known as the strike price, on or before a certain date, the expiration date. They can be used for various purposes. They can hedge against risk, generate income, or speculate on market movements. Premium selling is an option strategy that involves selling options contracts. Investors collect premiums upfront, but they take on the obligation to buy or sell the underlying asset if the option is exercised. This strategy can be profitable in flat or range-bound markets. However, it carries significant risk if the market moves sharply against the investor's position. Premium buying involves purchasing options contracts. Investors pay a premium for the right to buy or sell the asset. This strategy offers potentially unlimited profit potential, but the investor risks losing the entire premium paid if the option expires worthless. Market-neutral option strategies aim to profit from volatility. They involve simultaneously buying and selling options contracts. These strategies can be complex. They require careful planning and execution. They can help investors mitigate losses in volatile markets. Section 6. Market history offers hope. Market volatility can be unsettling, but it is important to remember that markets are cyclical. They go through periods of expansion and contraction. Volatility is a natural part of the market cycle. Understanding this can help investors stay calm and make rational decisions. Historical data shows that markets have always recovered from downturns. While past performance is not indicative of future results, it provides perspective. The stock market has experienced numerous crashes and corrections throughout its history. Each time it has eventually rebounded to reach new highs. It's crucial to maintain a long-term perspective. Short-term market fluctuations are inevitable. They should not dictate long-term investment strategies. Investors should focus on their financial goals and risk tolerance. They should avoid making impulsive decisions based on short-term market noise. Section 7. Time to adapt. The era of set-and-forget investing may be over. Investors need to adapt to the new market realities. Active management, diversification, and a long-term perspective are crucial. By embracing a more flexible and informed approach, investors can navigate volatility and achieve their financial goals. Remember to carefully consider your risk tolerance, investment goals, and time horizon. Consult with a financial advisor to discuss your specific situation and receive personalized guidance. What are your thoughts on the changing investment landscape? Share your comments below and let's start a conversation. Don't forget to like this video and subscribe to our channel for more insightful content.